We were in OpenAI is a big name. We've made an investment in Jackpocket, which was sold to DraftKings, had a nice exit there.
What's your favorite, SDE, Cashflow, or EBITDA?
If you're talking to a broker or a seller, you're talking SDE. If you're talking to a lender or an investor, you're talking EBITDA.
Let's say you buy this business and the operator's not good. Do you have recourse?
Private equity firms generally like to own more than 50%, right? Because they like to control. So they can fire you if they need to, because you are running their company, right? And they own that company.
All right, Dennis, why don't you have a solo GP model. Why don't you kind of just describe to me what it is you actually do?
Yeah, no, thanks for having me on. I think for us, we really focus on, the micro VC and micro PE space. Started doing investing out of a vehicle called Private Ventures Group, or PVG, 3 years ago, 3.5 years ago. And we've morphed that into investing in the SMB space with our SMB PE entity that's more on the media side. So, we look for interesting investments for our group of high net worth investors and family offices, and put some content around that to drive deal flow.
So a lot of people they know the words venture capital, they know the words private equity. Can you just give us a very quick, what's the difference between venture and what's the difference between private equity?
Absolutely. Yeah, I think, on the venture side, it's a very different investment focus, right? There, you're looking at a portfolio approach. So folks usually pick 30 companies, they'll place those bets, and, one or two of those bets will pay out an outsized return to your overall investor group and drive a portfolio return based on the other bets that don't work out. On the private equity side, it's much more of a focus of, I give you a check, I would like to get a check back. And there's more downside protection, a little more financial focus in terms of the business profile and the cash flow profile. And what we've done is really focused on the smaller part of that market, where a lot of high net worths and family offices are playing and want to access, really compelling private deals below where some of those larger institutional players play and some of the larger funds. So anything below $10 million in total enterprise value is kind of where we focus right now.
Okay. And usually the way I think about venture is like venture, early stage, higher risk type companies. They don't have to be tech companies, but are typically tech companies. Higher risk, higher reward. Private equity, lower risk, lower reward, but it's kind of where you park your money not to lose it. I'm expecting a check back in return. So tell me, you started with PVG?
Yeah, so I've been in finance now for 11 years, and went off my own 3 years ago to start our own shop, and that was PVG. So the initial focus there was to get into blue chip venture capital deals and access really compelling venture investments in the private markets. And 21 and 22 there were a lot different than today in terms of where we were as a investment market. But before that, spent a lot of time at JP Morgan and in private equity, putting together what they call SPVs, which are special purpose vehicles. Not to get too acronym focused for the folks out there, but think of it, as a pooled investment, right, for private investors. So, traditionally, the costs of those vehicles have been higher than they are now, and it's allowed a lot of folks to make independent bets as smaller firms like myself and a few others we work with on interesting companies. And so, working in that space, we put 25 deals together in the last 3.5 years, equity investments into companies. And in the last 8 to 12 months, we've pivoted over to the SMB space to back self-funded searchers because the way we're set up, the equity checks that we're putting to work generally will work well in terms of size-wise in this space as well. Or that's at least the thesis.
Oh, interesting. Okay, so on the venture side, you raise money, right? Can you disclose how much money did you raise for PVG?
Yeah, sure. We have just over $5 million of AUM right now. So small checks, think anywhere from $200K to $1 million, I would say, is sort of the check range that we focused on.
Okay, that's what I was going to ask. And so on the SMB space, what you're saying is you're primarily investing in searchers?
Yeah, we took time in 23. I think that was a pivotal moment for this small investment firm that we have, where the venture market had gone through quite a up and down, if you will, following COVID and a few other things, where 21 and 22 were very up and to the right, and 2023 was more of a where do we stand as a venture market. And I think we have a lot of really compelling investments there, and we're still backing the founders that we've worked with. But going back to the drawing board, I spent time in JP Morgan's M&A group and understand M&A quite well, and have been reading more and more about some of the online M&A going on in this space, especially in boring businesses. And we took the time over the last 8 to 12 months to say, hey, look, instead of doing what we've been doing, where we go out to investors, we'll send them a memo. There's no fund vehicle. We underwrite each deal individually and ask them, hey, do you want to participate in this deal? Instead of doing that on the venture side, we've shifted that over to the boring business side now to back self-funded searchers, just given that the equity checks do line up in terms of sizing well for those folks too. So the idea now is to find searchers and entrepreneurs that are looking to buy businesses versus, to your point before, in the venture world, take riskier bets where you're trying to grow something very big, very fast, and very large.
Okay, so you still have this fund, the PVG, that you guys you're managing assets.
Yes.
Is that capital fully deployed, or are you still making small bets?
I would say right now I've sort of paused future bets in the venture world, except for follow-on capital in our current portfolio. And then we've gotten full tilt into the SMB world with a lot of content and focus around back-end searchers there. We still get a lot of opportunities on the VC side, but we found that I wasn't going to be able to do both of those things at the same time. Just became too much to work on. So there we have some good bets. We're in OpenAI is a big name. We've made an investment in Jackpocket, which was sold to DraftKings, had a nice exit there. So there's some good names and some not as good names, but overall really focused on maximizing our investors' returns there. And then here going forward, really have refocused them to say, hey, let's go try and back a few self-funded searchers around our new content, our new outreach. And so that was, certainly a big pivot to explain to our investors, but I feel like we're in a better spot for it and have a better hold on our inbound deal flow now, just given the way it's lined up.
Okay. I really want to talk about SPVs, and I really want to talk about the way that you're utilizing media to essentially create deal flow. But before we get into those two things, I want to go through like searcher, quote unquote, because there's a traditional searcher, and then there's now this self-funded searcher that I think has become popular over the last few years. There's the traditional searcher, graduated usually from a top MBA, Stanford, Harvard, Chicago's Booth, Wharton, wherever. And they become a quote unquote searcher. They go out to the market and they raise money from individuals that will pay them for 2 years ish to go buy a business. So usually they'll raise, let's call it $300,000, $400,000, $500,000. They'll pay themselves a salary, but then they'll also use that money to go to conferences and network and lawyer fees and all the things. And then when they find a deal, they'll go back to those original investors, and those original investors will get an opportunity to invest in the actual deal. And they'll get a step up in that original investment, but they'll also be asked to contribute capital in order to close. Okay. So that's like the traditional searcher model. But there's now a new searcher model, which is I'm an entrepreneur, or I'm a entrepreneur. I want to get into entrepreneurship. I want to buy a business. I'm looking for a business to buy. I have a W-2, but I don't have the capital to close on a business. So I'm going to go out and raise money to essentially provide gap funding, right? To close that business. And then whoever's investing in that obviously gets a piece of the business. Are you investing in both of those models, or are you investing in one over the other?
Yeah, no, it's a great question. We're really focused on the self-funded space. To your point, I've done a lot of work over the years. I felt like with more of the traditional search folks, which I viewed as small private equity funds, right? So those folks they generally have a pretty formal board. They have investors that are involved in the process, to your point, upfront. And over time, they'll pay for a search for a couple of years for those individuals who will go out and develop a thesis, try and close a business. It's usually, a larger fundraise, a few partners, and again, a board, just very formal process in that standpoint, and usually an MBA focused graduate. What's developed in the last couple of years, I would say more on the self-funded side, which is where we focus, is the use of the SBA loan program and going out and buying a deal yourself. Under $10 million in deal value, under $5 million in deal value, majority of the time. And that combined with the proliferation of some of these online tools has really led to a market where you can go out and buy a company yourself versus starting it from scratch. Yeah. And the big argument there is you're starting a company with customers, with employees in place, with a lot of the hard stuff already taken care of, versus on the venture side, traditionally you're starting from the ground up, which just has generally a higher failure rate. Right, just harder to start companies from scratch. than buying something established. And you combine the two of those with the wave of retiring baby boomers in the space, and I think you're at a spot where there's a big push in that demographic of businesses that are profitable, have been around for a long time, and are, up for sale, if you will, in the next couple of years, due to a lack of a transition plan for folks that want to execute in this self-funded space. So that's kind of where we'll be focused. The traditional search folks have a really good network going there too. It's just a little bit of a different model, a different approach.
What about the target businesses? Like traditional search, they're going to be like $2 million in EBITDA is sort of their low end. Sometimes they'll go below it, but they're low end, and then they move up from there. But the SMB space, when you're talking about going through the SBA, signing on a personal guarantee, individual going and buying the business and owning the majority of the equity, I don't think of that as typically $2 million in EBITDA. I think of that as lower. What are the type of deals that you're looking at?
Yeah, that's exactly where we sort of drew the line too in talking to friends of ours in the private equity world. We started off with a larger institutional lender and said, what kind of deals are below your threshold? And they threw out $20 million. They're a bigger person in that space, so we started to go down towards lower middle market.
20 million
private equity firms.
Or $20 million in EBITDA.
Sorry, $20 million in EBITDA.
Okay.
And so much larger lender, yeah. And then that's what you get sort of in that institutional world. But went down to the lower middle market, and to your point, they said anything below $2 million, we don't really go after, and we don't really keep books on or focus on. I think maybe some of that's changed recently, but to your point, these self-funded folks typically are looking for companies with as little as $600K to $1.5 million of SDE, which is another metric used in that space. But think of it as cash flow, similar to EBITDA, a little bit differences there. But $600K to $1.5 million in EBITDA or cash flow, and below that $2 million threshold. And what they'll do is use an SBA-backed loan to purchase this business plus equity without partners, right? So it's usually a solo individual who's going in there. So from an economic standpoint, they don't need 2 or 3 salaries and a larger company with $2 million plus of EBITDA. They're looking for a much different business profile in that sense. So it opens up a pretty big universe of companies that are out there below that $2 million threshold that you mentioned before.
So you're investing in the below $2 million threshold?
Yeah, that's kind of below $2 million of cash flows where we're focused. I think that's where a lot of individuals can make a move and need some equity to make it happen.
Okay. And maybe we'll talk about the difference between SDE, EBITDA, and cash flow. Everybody uses it the same way.
At the end of the day, you always have to find your own numbers that work, but they're all used interchangeably in this space.
What's your favorite, SDE, cash flow, or EBITDA?
It depends who I'm talking to. I always tell our folks, we try and help people find companies too. If you're talking to a broker or a seller, you're talking SDE. If you're talking to a lender or an investor, you're talking EBITDA. So if you're below the $2 million threshold, you have to be able to speak both languages, if you will.
Yeah. And for those of you listening, SDE, seller discretionary earnings, is typically just anything that the seller took home, quote unquote. EBITDA is much more in line with GAAP and is your earnings before interest, taxes, depreciation, and amortization. But they are not the same. They are definitely not the same.
Definitely different. The one thing with SDE to think about too is the big distinction is think of EBITDA plus the owner's salary and any payments to the owner and discretionary owner spending, right? So a lot of folks run a lot of expenses through these businesses, are very attached to them, and they'll take those expenses and add them back on the broker side to tell you as the new buyer, look, here's all the cash available to you in this SDE metric. But it's definitely confusing to folks.
In that range, why do people like using SDE versus EBITDA?
The thinking there really is the sellers are really representing all of the cash that's available to you, right? They're going to go through the books and say, look, here's a business, everything that's thrown off. But to your point, as the buyer, you have to make adjustments for new salary needed, new hires needed, all that stuff on your end anyway. But it's generally because, of the way that these owners are very involved in these businesses, and they want to represent that from that perspective of how much cash is available to you to make your decisions with. And, it can confuse some people, but, there's ways to go through it and figure out what's what.
Yeah, and the only thing I would add is usually in those size of deals, SDE is going to be used because the person who's buying is going to be an owner operator, and so they don't care as much about EBITDA. Like I don't care what the depreciation or amortization is on the like. what can I expect to take home as this new owner operator? But it runs into conflict when you get people like you who have a fund or are investing in the space, looking at it as a business that can potentially grow and scale. You don't care as much about SDE, you care about EBITDA. But
Yes, and the lenders too. They're definitely EBITDA folks.
yeah,
But
yeah.
it's
So
interesting.
tell me, because this was the thing that I got the most interested in. Tell me about SPVs. So, like, I know it's a word. I know that it's used. What the freak is an SPV?
Yeah, no. So I mean, it's the first time you hear it, you always say, "What does that mean?" I mean, it's a very strange acronym, and special purpose vehicle is a mouthful. But think of it like a very simple investor group or pool of assets that's investing in a company. So they've been used. You can use them all the way up the chain, right? You can do really large Series D investments with multiple hundreds of millions of dollars in an SPV, right? But that's just referring to the vehicle itself, right? Think of it as a EIN and an LLC that holds investor funds that can then be invested into a company. I started doing them what is now 8 years ago, and we use New York-based lawyers and New York-based private equity firms. And as you can imagine, that wasn't as cheap
Yeah.
as some of the really interesting online solutions now. So, the easiest way to describe them to folks is all of your friends who invest on something like an AngelList, they're using SPVs as the vehicle that, makes a contract agreement with you as an investor and then invest into the cap table of a company in one line item, right? That's
Mm.
kind of the simplest way to think about it. And from the company's perspective, instead of picking up, 50 small investors, they can just take one line item, and for the GP or the smaller investor in that space, they can get into more deals because they have a more institutional offering where they can just go under a company's cap table with one line item, again, without 50 different small investors the company doesn't want to deal with. So given the latest run up in the market in 21 and 22, you had a big spike in online providers in this space, and there's a lot of solutions around how to create these vehicles. The other benefit being, besides just the cleanliness, if you will, on the investing side for these companies, is the tax side. So, in general, they're created to distribute tax documents to your investors on time as the GP. So it works in both ways. The company gets a clean entry from you as an investor, and then you can, service and manage your investors out of that vehicle.
So, like, I'm thinking of the real estate model. I have a friend of mine who he raised a fund, right? And it was almost like a search fund, to be honest with you. He's like, all right, I'm raising a fund. It's the GP. You're going to pay me essentially for 2 years to look for that first deal. We're going to build out the office infrastructure. And then when we find deals, these are real estate deals, we'll go back to LPs and raise money for each one of those individual deals. The GP will get a certain percentage, the LPs will get a certain percentage, et cetera. Was he just describing an SPV and just didn't use the word?
Probably, yeah. No, it's often used too with fund vehicles. It's kind of traditionally how it's probably used the most, I would say. A lot of times on the VC side, folks will use it for example, a follow-on deal where they're constrained, right? So if they put in X amount of dollars, but they have an allocation in a company they really liked, they'll open up an SPV, offer it to their investors, let them do more capital on. To your friend with the real estate fund, they're also very familiar with this structure. If they're using some sort of fund investment, they might create an SPV alongside one of their fund investments to increase the equity that's going into the deal if they want to, or size up or size down in supplement to the fund itself. So they are used quite a bit supplementing funds.
At what point do you do the SPV? Are you, if you have one person who you're going to raise money from to help close this deal, do you do an SPV, or is it just once it passes 3 individuals who are going to be owners in the company, you should probably have an SPV? Like, how do you think about when to do an SPV?
Yeah, so for us, it really depends on the deal. We generally underwrite the deal up front and then bring it to investors. The idea there is to offer your investors the ability to look through the menu, as an old client of ours told it, right? So if you're a fund, you're generally investing in everything at the restaurant, right? So you have, or if you're doing one of those all-inclusive meals, right? Everything kind of comes out as is. This allows you to look through the menu of the fund and pick out just individual deals, right? So while it can be a little bit more burdensome in terms of work, generally how it works is if you find a compelling investment, you'll then underwrite it, go through your processes with your small investment committee or yourself and solo GP and maybe a few close advisors and talk about if it makes sense. Then from there, you put together materials and go out to your broader group of investors, ask them who's interested, figure out if an allocation makes sense, and go back to the company and communicate that. A lot of times it kind of just depends on investor interest.
So I get why it'd be advantageous for you as the fund to essentially have these vehicles for every individual deal that you're doing. It makes it a lot cleaner. Talk about the tax benefits of doing an SPV versus doing it the other way.
Yeah, so I mean, look, if you're a first-time fund manager, there's a lot to do, right? I think folks think sometimes, oh, a fund's just sitting back and investing and reading, a bunch of sims and stuff, and that's totally true. But what you're really doing as a fund manager when you first start is, let's look at it two different ways. If I can raise 5, 10, $15 million on a smaller fund, maybe $50 million on a bigger fund, whatever that looks like, that's a very different conversation than raising an SPV and doing a deal first and going to investors and saying, hey, can I bring you this deal? So from a mechanical standpoint, as an early fund manager, it helps you in the sense of you don't have to do all the complicated part of raising this big fund. You can go to investors first and give them a proof point, right? You can put in front of them on paper, hey, we have access to this deal. We're doing this deal. Would you like to participate? So it's a very good vehicle for junior managers. And then to your point on the tax stuff, what it's able to do for a lot of these folks is it essentially forms a entity, right? And then you work with great accountant teams that are out there and put together what they call K1 partnerships and issue all of your investors at K1 through this investment entity at the end of the year. And it can be varying levels of difficulty there. We found on the self-search side, it's actually more complicated than the venture side, but it does allow an accountant then to issue all of your LPs through this tax ID and this investment vehicle, all of the necessary tax documents that they need, which when you're first trying to figure out how to do a fund and make an investment is definitely a big part of the pie, if you will.
Why would it be advantageous for a searcher? Like, why would I as a searcher be like, oh, I should go raise an SPV?
Yeah, at first we were looking at these, you see a lot of folks on the internet talk about how you can, buy a business with 0% down and live on the beach and, drink Mai Tais. And, I'm sure some people have done that and been successful in the very small minority. But, in general, when you go through these investment processes, 50% of the companies we're looking at under LOI don't go through, right? For the searchers, they're putting up costs out of their pocket for legal, for accounting, for a few other things, right? It can be some significant cash out of pocket. And they're also searching for these companies for multiple months. Some of these folks are employed. Some of these folks are not employed. And all of the time that they've spent searching for this company might be quite a few paychecks that they've missed. And then the closing gets delayed 30 to 60 days later than you thought, right? These are all costs and time and things that go into this deal that when you add it up, it can be a few $100,000, right? For folks, depending on what kind of deal size they're buying. So we found that if I'm a self-funded searcher, it might be better to sell, 10, 15, 20% of the equity, take on some cash. That way, when I buy this business, I'm not completely cash strapped as an entrepreneur, right? Where in case something goes wrong, I get sick, God forbid, life happens. I have some extra cash on the balance sheet and I'm able to run this company, right? I'm taking on investors where, I'm still owning 70, 80% of the upside of this business, but I took on some cash from the outside to just lower the overall cash I personally have to put up.
So are they taking cash in to help with those deal related costs, or is it just at close, hey, this is how much equity we need, we go to an SPV and we get that injection?
It really does depend. I would say for the most part, it's going to be this is part of the closing conversation that this check comes in because the investors are backing a lot of your risk, right? So from their perspective, they're giving you a check and, maybe you've never run a company before, maybe it's your first time in whatever industry. It's definitely a lot of risk, but what you're getting the benefit of is you're not having to put up, again, personally, a few $100,000, which is a lot. And as long as you run this company and pay off the debt that you're now fully in charge of, majority owner, our check becomes a little bit of a hybrid VC and PE in that standpoint where we're a minority owner and really it's your job to run the business and do well. We can obviously offer tons of support, but if that person can then run that business, pay off that debt, they'll generally unlock, a significant wealth creation vehicle for themselves by running this company as well as, personally and professionally outside of that. So it really kind of lowers the burden on them on the front end side where they have so much to do towards close, maybe not completely cash strapping yourself post close helps you from a stress perspective or a number of other looks at it.
So on the traditional search side, from what I've seen, traditionally what they'll do is they'll be like, okay, you searcher, you've gone out, you found this business, you brought it to the LPs, they're gonna put money into it. You get 10% equity upon close, you get 10% equity if you hit certain metrics, and you get 10% equity upon exit, depending on the multiple. So you could, potentially you're earning up to 30% of equity in this business, but you could be fired at any time. You could be replaced. That equity doesn't necessarily vest. It just depends on the vesting schedules, all those things. What does it look like with these SPVs as you're putting money into SMBs? Like, what does the equity structure look like between the searcher and between you, the fund?
Yeah, that's really the big benefit, I think, on the self-funded side. While you can do a much larger deal on the traditional side, I generally think of the economics sort of like a third, a third, a third, and you can earn, to your point, up to a third of your own equity over the course of the deal. Your investors are then going to talk about the other 60% between debt and themselves. On the self-funded side, it's very much different. So what's going on here is you're going out and sourcing a deal, right? You're signing up to then finance it with an equity down payment and what should probably be an SBA loan, right? Taking advantage of the SBA loans program in this space. Upon close, you are then going out to investors and saying, hey, I'd like to raise some equity. In general, to your point, you're going to raise about maybe 10 to 30%. And from the investor standpoint, they're not going to want to do much more than that because they don't want to sign over 20% to sign on to the personal guarantee. Now, does that happen? Certainly, right? But there's a personal guarantee involved with these loans. So when you are signing on to the company, and structurally what happens is you'll go raise 10 to 20% of this equity, but you'll still own 70 to 80% of the business post-close because you're personally guaranteeing the debt and the rest of the deal, and it's your company, to your point, that you're owning afterwards without a formal board advisory, right? And the reason I think a lot of the differences there are, to be fair, the traditional search guys, they're raising much more money, doing much bigger deals. Here, you're financing it with a lot more debt. It's a much highly levered vehicle, plus an outside investors coming in for a smaller amount. So you're able to own it with much more upside.
So after close, your fund is the SPV is owning between 20 and 30%.
Yeah. So in general, the pricing I've seen in market for equity right now is probably like 1.5 to 2.5 step up from other funds that we've seen, and that step up means whatever dollar I give you lands in that amount post close in terms of ownership. So let's say I'm putting in 10% of the deal, I'll own 15% as that part of that step up. And then for rates right now, it's early November 2024. We'll see where rates go. Preferred rates on that are generally around 10 to 12%, I would say, in terms of annual coupon. So you're paying back that coupon to those investors, and that's because given where rates are, right? And post close, you're then you own again like 70 to 80% of the business, so you're really in charge. You have majority control. And these investors are in your cap table as an additional way to raise some equity and reduce the overall burden on your personal balance sheet. It's a very personal conversation.
If I'm buying a business, it's $1 million value, and I want to raise some money, and maybe I've got to put $150,000 in, and I go and raise $100,000 with an SPV. Okay, so that's 10%. That would be 10% of the deal, but we're talking about a 1.5 times step up, so that 10% actually turns into 15% equity to the SPV. And then on top of that, there would be a preferred return to the SPV of 10 to 12, let's just say 10%. So the SPV puts in $100,000 every year. There'd be a minimum expectation of $10,000 return to them, either in the form of a payment or accruing a balance. Or like, is that how it would look?
Yeah, it then becomes there's a lot of ways to structure it. So I don't want to give one structure, but to your point, yes, that's generally how it would work. Is either it'd be a cash payment back to the investors until they're made whole, and then there'd be some change on the preferred, maybe down to common, or it could be what they call PIK, which would be delayed accrued interest that's being earned, or it could be a combination of the two, where there could be a certain amount of period that there's no cash dividend paid that then flips to cash dividend in X year, right? So you could say PIK for the first 2 years, right? PIK being accrued, we'll say. And then in year 3, we want cash dividends to turn on. And you might do something like that in a deal where you want to lower the cash burden on the company for the first 12 to 24 months when some of these things tend to be kind of hard, right? So there's a few ways to structure it.
So for you as the fund, what recourse do you have? Let's say you buy this business and the operator is not good, or stuff's not going well. What do you have recourse? Are you just at the mercy of the operator? Like what does that look like?
Yeah, I mean, you're like that's the thing, right? You're kind of at the mercy of the operator in that sense, and this is
Okay.
why private equity firms generally, and look, there's tons of protections you can put in there, but from the overall deal perspective, private equity firms generally like to own more than 50%, right? Because they
Sure.
like to control, so they can fire you if they need to, because you are running their company, right? And they own that company. Here, you're taking more of a bet in the sense of, well, I'm putting cash behind this individual and this operator, and they're signing on the self-funded side specifically, again, not the traditional side, they're signing debt that's senior to us, right? So the SBA is going to eat first, and then you're an equity investor behind that. Now you can build all kinds of things into that, but if the company goes south, that's why it's more of a venture bet in that sense. It's a little bit riskier than your traditional sort of buyout private equity style bet because you're junior to the SBA debt in that sense as an
Mm-hmm.
equity holder, but you are getting paid. You're being compensated for that given the step up in the higher preferred dividend that you're paying. So it's all part of how you structure that and think about it from that perspective.
For you, you've got kind of like an interesting deal flow, which I find fascinating. So like I'm on
Yeah.
Twitter. I've met lots of people. I've invested in a few self-funded deals, right? But not through an SPV. It was just me investing in those deals. Talk about how you find deals.
Yeah. So I did the first 3 years of this traditionally, going through and meeting folks and building a network. And that's also a great way to do it. You generally build really good relationships with specific funds and do, most of your deals with what I would call 5 to 10 really close funds. And then outside of that, you could do one off here and there with newer funds that you meet along the way. And that was working great. From a lifestyle perspective, maybe not as much. I was up all hours of the night all the time and a lot of long phone calls. And, at the point in my life where I now have a fiance in my life who said you should probably sleep some more. So, as you're talking to people in your life about that, you get to a point where, I few founders that are brilliant over there that I've worked with, and one was me and him would go back all the time on late night phone calls and just say content, content, content. We have to do videos. We have to do videos. And it's easier said than done because it's I feel like you really like doing these interviews and you have a good thing going. But for us, we just couldn't figure out what to do. And to be fair, a lot of the VC stuff is under heavy NDA, right? It's very, very hard to talk about publicly. So we switched to doing content in the SMB space as part of our process, and we do a different boring business every single day. So we've done 150 of them now, and it's just been very popular. And I remember we first launched them, and I'm not a big social media person, but just coming from finance, you can't really even have social media on your computer. But we launched it in June, and it's just done very, very well. So now we get a lot of deal flow from our daily videos in terms of folks in this space. Hey, can you write us an equity check? Hey, can you sell a company? Hey, can you do whatever? Just driven around a daily content vehicle.
Okay, you've said we many times, an hour, and who's we? I thought you were a solo GP.
Yeah, no, I actually have like a small team behind me now, which has been fun.
Cool.
So it's taken a while to get there. We started dipping our toe into the hiring last year, but I always like to refer to us as we because we do have a team behind here. But
Okay.
yeah, it's definitely something where I didn't expect to have this kind of reach right away, but it's definitely a very popular space right now, and we'll see kind of how it kind of moves from here. But figuring out how to work on that channel and drive some deal flow at first was hard, but now that we've put a few months into it, we have a much better understanding how it all works.
It's crazy. It's only been a few months. How does the GP work? So you go and raise these SPVs, these special purpose vehicles, and I'm just assuming you have just a percentage of managing it, or like how do you get paid?
Yeah, no, I mean it's a traditional 2 and 20 structure. Or at first it was 0 and 20, just to get folks in 21 and 22, and then realized we should probably start charging some management fees. Wasn't coming all out of our pocket, but I think it's traditional 2 and 20, and I provide a lot of access to our folks, so I'll bring them deals. There's a lot of smarter LPs in our space, in our group than me, right? They're very successful folks looking to deploy capital, and the way it's structured is much more of I bring you a deal, you can make up your mind or not if you want to come in, and for me, it's there's no forcing or pushing people into stuff, right? There's really no fund vehicle there. So I have some folks that I know like certain things, and I have some folks that like that know that like other stuff, and that's how we operated for the first 36 months. And then we've developed this strategy now going forward to kind of focus our efforts here.
Okay, so you got the 2 and 20 model, and for those listening, 2 and 20 just means you charge 2% for assets under management. So if you've raised $5 million, you're paying yourself, what is that, $100,000 a year?
Well, it should be, yeah, now that we've turned down fees, but it's not quite how it works.
I know. I'm just for illustrative purposes. And that was on the private or the venture side. I think you've raised a separate fund for the SMB space. But anyways, and then the 20% would be, you would get 20% of the upside in these deals. That's a very easy way to say it. I'm sure there's a lot of nuance to it, but that's effectively what it is. How much capital have you deployed on the SMB side with these SPVs?
We haven't done a deal yet, to be honest. We had a deal in late August I thought would be our first, and it was a good learning experience because the fund itself is a little bit different in terms of underlying costs. So, and it turns out your accounting fees are very different, legal fees and stuff like that. So we'll get there. But the deal itself was great, and we were able to raise enough money, just couldn't actually close the company, which was interesting. And then we had another deal, a towing company that we were looking at for a few months that ended up falling apart in October. So good understanding of, look, these deals are not always going to go through. And then I think our other focus really on the SMB side is, if you think of PVG as our investing arm, the SMB side has been a good media arm, right? It's driven a lot of deal flow. So naturally, we're doing some advisory on that side too for companies that want to sell. We've had 3 or 4 clients up that want to sell. So we're doing a little bit of investing and a little bit of advisory on that side.
Are you finding the deals and then finding the operator? Are you finding the operator and then finding the deals, or at the same time? Like, how are you sourcing those?
Yeah, I would say we're mostly doing the operators coming to us. So I'd say it's post LOI. They've been out there searching for a little bit. They come to us and say, hey, look, we have a deal under LOI. We're trying to close it within the next 60 days. Can you go out to your investors during that time and raise capital? And we'll take a look at the underlying SIB, understand the searcher themselves, do some underwriting, and then take it from there in terms of getting interest. But it's usually post LOI. And given we were, used to doing stuff on the VC side in very short turnaround times, it kind of works out well here where we can, essentially work alongside that self-funded searcher as a buy-side advisor and capital raiser as they go towards close.
So before I ask you my last question, which is, where are you seeing the best opportunities right now in the SMB space? I want you to tell people, where can they come find you?
Yeah, check us out on Instagram at smb.pe. And that's probably the best way to follow along our daily videos, give you some ideas about boring companies we look at. And, there's all kinds of links and stuff on there you can follow. But in terms of places that we're seeing the best.
Yeah, what businesses or industries are you obsessed with right now that you're like, that's where I want to invest? That's where I see the best opportunity.
I think so. The number one thing for me is the people that are retiring right now that have businesses of 10 plus years. Just from a underwriting standpoint, you talk to some of these folks, they have really, really strong companies they've built for a long time. You talk to folks that have been through multiple market cycles, multiple crises, and they're still here and they have a great team, right? And so from a people perspective, you have there's a natural entry point there with these boomers where people throw out these stats. There's 10,000 retiring a day. 8 to 10 of them own a business. That's 800 to 1,000 businesses a day that are up for grabs. 365,000 companies a year. It's a lot of companies. So from that perspective, I really enjoy talking to these business owners that have been around for a long time, and their main focus isn't always price, right? It's usually, can I get in touch with someone to sell to who's really going to take care of my legacy and what I've built, right? And that part's cool. And then to your second point, what's the most interesting industries? I would say just some of the niche industries that we find, right? Now that we've done, 150 of these daily reviews, we've got, 600 other whatever companies we've poked around at, 1,000 other companies that before that. And, you find these strange companies. Like there's a guy from JP Morgan who, I know, and he bought a milk testing company in California, right? The deal that we talked to in August, they help libraries and public schools test telecommunication services and get contracts. So it's really just some of these interesting niches that you find that you would never have thought of as you're going through everything, where you're like, man, that's how they make money. And I think that part to me becomes some of the cool stuff as you see these companies that, they might not have a big multiple on them. They might not be growing anytime soon, but they throw off a lot of cash and they've been doing it for a long time.
Okay, I'm tired of you giving me the hedging answers. I want to know, gun to your head. You have to choose one business. It's your money. You're putting it into it. You're not an LP. You're not investing in the business. What would you pick right now as a business to own, operate, and invest in?
Probably elderly care. I think there's just a lot
Really?
there. Yeah.
Okay.
I think it's a tough space. It's a hot space. It's not necessarily the easiest, but if you can find something that's been around for a while with a good, um, interesting background and the right team in place, there's just a huge, a huge service to be done there for a population that's getting older. And maybe it's because I think about it quite a bit because my fiance lost a grandma last year, but being around a lot of those homes, it was just kind of like, man, there's a big need here for people and help and all that kind of things. And usually when there's a big problem or a need coming, that's a decent place to focus. So, I think there is a good space to look at, but I'm not the only one looking there. There's a lot of people interested in that space. So it could be kind of crowded. Yeah.
I had a medical billing coding company. I had a home health, hospice, home care company, medical staffing. So I love that space. It's a great space, growing like crazy.
Yeah. So it's probably one. And, if you had to, gun to my head, another one, it's kind of hard. I mean, it really, I would say a lot of people ask me that because, and not to go too long winded, but I'll get that question online a lot. And they're like, oh, I want one business I can buy. And I'll say to them, you know what? If you look at the underlying businesses here, a lot of them are different, right? You might have one company with a great owner, one company with a horrible owner, one company with great books, one with terrible books. So once you kind of get inside a little bit, like you're 2 layers in, you start to say, oh, this is a good company or not. And that kind of happens on the, post first find, right? It's kind of under NDA once the story's being told. So it's not always easy to pick one industry, but yeah, I think the home care center is not stopping anytime soon.
That's why I asked what you would pick, because I think it's so person dependent. Like, it's hard to make a broad statement like, oh, the one industry that you should do is like, well, I don't know what your experience is. I don't know what you like to do. I don't know what your skill set is, like, et cetera. But you look at so many businesses, I'm sure there's obviously the home care side of things, or at least healthcare, elderly care side of things is appealing to you. And that's what I find interesting is, like, as you're looking, what do you think the biggest opportunities are? And you said it. So this was awesome, man. Appreciate you coming on.
Yeah. Thanks so much for the time. And, hopefully answered all your questions, but thanks for having me on. Appreciate it. And talk to you soon.
Let's do it.